The best trading strategy that won the US Championship. We take a look at a well-known trading method that is known as the power play setup in this video. One of the most successful traders on the planet, Mark Minervini, who has won the United States Investing Championship twice, is the one who has come up with the phrase strategy. First things first, before we get into the mechanics of the setup, let's have a look at Mark's most recent performance in the United States Championship races. As a result of his participation in the $1 million plus division, he achieved a return of 334.8% in just 1 year, resulting in him finishing top for the second time in 2021. Even though Mark employs a few different strategies to attain such returns, his concepts are similar throughout all of the ways that he discusses them. His trading techniques are built on the foundation of trend, consolidation, breakout, volume, and effective risk management, among other things. The following statement sums up Mark's strategy. I stuck with the same style of strategy for so many years that I got good at doing that one thing. I was doing the same thing that I am doing right now, which is looking for equities that are in strong uptrends and are emerging from consolidations. Mark's technique is based on an idea that is very similar to the one that I employ. To commemorate our recent achievement of achieving 100,000 members, I have also decided to participate in the same United States Investing Championship for the year 2023. Those who are interested can follow all of my transactions in the competition by subscribing to the channel and utilizing the links that are provided below. An examination of Mark's power play setup is in order. William O'Neill, the person who created the can slim trading method, popularized the high tight flag, which has several similarities to this setup. Patterns, a study that was conducted not too long ago and spanned 10 years, placed the flag pattern among the top 10 chart patterns with a success rate over 67%. Following a period of stagnation or consolidation, the flag pattern, like many other effective patterns, begins with a strong preceding upswing. A period of consolidation follows, a phase in which the price digests the supply that was built up from the previous upward rise while simultaneously tightening and preparing itself for the next move is referred to as a volatility contraction. This formation of a flag-like channel is also known as a volatility contraction. There is no denying that this is a very basic illustration. For a more concrete comprehension, let's have a look at the template that Mark has provided. The requirement that there be a robust underlying demand for the stock is the first parameter that must be met. The price is showing a strong upward trend, which makes it easy to identify this demand. The most profitable moves frequently occur after a considerable increase in price as a result of significant demand, which may seem paradoxical. After a surge of this nature, many investors believe that prices have reached an overbought level and are ripe for a correction. On the other hand, this is frequently a prototypical illustration of purchasing high and selling even greater values. Astute trading professionals can identify momentum and capitalize on it. With the formation of the volatility contraction pattern, which occurs with an increase in demand, the next criterion is present. The pattern can occur at any time and typically starts with some profit taking, then increased demand, a rebound to the high, and then another, less significant pullback. This is another instance of it, which results in a string of higher lows and, as a consequence, the formation of a rising support line during the process. As a result of the price being pressed down against a certain level of resistance, we can now plainly observe the shrinkage of volatility. As we get closer to the pattern's conclusion, we want to see a decrease in volume in the same way that a decrease in volatility is pushing the price down. The decrease in volume is a sign that there is a shortage of supply, and it frequently comes before a pocket pivot, which is more usually referred to as a breakout. At this point, the volume and price action become the primary focal points of attention. If all goes according to plan, the subsequent stage will be characterized by a breakthrough over resistance at the pivot with a significant amount of volume. A breakout that does not show a considerable rise in volume ought to be kept in its current state. A more in-depth discussion on the topic may be found in a video that was previously uploaded on the topic of volume and price action. The stop-loss position is something that needs to be taken into consideration now that we have found the buy points during the break. It is possible that it would be put just below the pivot, possibly here underneath the wick of the candle that came before it, even though its positioning is subject to some degree of subjectivity. At this point, we can ascertain the risk component of the position. We can acquire a better sense of the potential if we look further out. Through higher lows, we witnessed a reduction in volatility, a dry-up of volume, a breach of resistance with rising volume, and our defined risk. All of these events occurred simultaneously. On the chart, the risk-reward ratio was equal to 1:6 as a result of the continuation of demand, which is a promising critical statistic for any strategy. A reduction in volatility can manifest itself in a variety of ways. Some of them will be long, some will be shorter, and some will be shallow in a more lateral form. The word consolidation is the most important one, regardless of how we understand it. It is necessary for there to be a tightening of prices, which functions like that of a coiled spring, thereby increasing pressure and serving as a stimulus for the subsequent shift. According to this theory, contraction comes after expansion, and then expansion comes after contraction. Because of this, you will frequently observe these patterns manifesting themselves on the charts. This contraction offers a logical justification for placing a trade with low risk, and it forms the basis of almost all strategies employed by illustrious traders. This is the secret component, which I address in other videos, which is that with a high probability, low-risk strategy, you can use appropriate leverage to significantly boost returns. This is exactly how Mark was able to get a return that was greater than 300%. Let's take a look at some of the traders who came before us and the different ways in which they approached the market, even though they were all based on the same ideas. The first person to be mentioned is Nicholas Darvas, who is well known for his work on the box method. He was specifically looking for a price increase, lateral consolidation, and then a breakout that showed an increase in volume. Jesse Livermore, one of the most prominent traders, was also interested in periods of consolidation. He categorized these periods as pivot points, which are typically discovered following periods of growth and contraction. He intended to trade them in the same direction as the last move, and he would anticipate that the move would continue after that. Dan Zanger, another well-known trader, trades the breakout from a basing pattern with the moving averages in his favor and conviction through growing volume. He does this by trading the breakout from the pattern. Additionally, he searches for a stop loss that is tight to provide leveraged returns. Christian Kolomagi, a trading millionaire who operates in the present, once more uses the fundamentals of prior demand, consolidation, tight stop losses, and support from moving averages. Within the context of an uptrend, David Ryan, who has won the United States Investing Championship 3 times, searches for moments of consolidation by employing patterns such as the cup and handle and volatility contraction patterns. The legend Stan Weinstein examines the weekly charts, looking for times of consolidation and breakouts that show volume and examining the moving averages to ensure that he is following the trend. A perceptible demand, the type of consolidation, a breakout of resistance with an increase in volume, and low-risk entry locations to acquire a favorable risk-reward while allowing for leveraged gains are the principles that stay constant about trading, regardless of the trader, the time frame, or even the asset. The fact that Mark recently shared a Dow Jones chart from 1903 serves as proof that the hypothesis has been valid for more than a century. It displays a similar pattern of volatility contraction and then a breakout in volume, all with the help of moving averages. Thanks for watching. Please give me your available answer in the comment section below, and don't forget to like and subscribe to our YouTube channel and hit the bell icon for more interesting and informative videos.